Hello, we're at the Morningstar Investment Conference in London, and I'm joined today by Karen Ward, Chief Market Strategist for EMEA at J.P.Morgan Asset Management. Karen, thank you for joining us. So let's look at the bigger picture around the world. There's quite a lot of negative headlines out there. So when you think about that, where actually are the opportunities?
Well, I think it's worth thinking about what caused the downturn last year. And I think a big part of that was China. China slowed quite sharply last year. It was self-engineered. Beijing wanted the Chinese economy to slow, but it did turn out with the US trade hostility combined, the slowdown was sharper than they had hoped. But the ripples of the Chinese slowdown were felt very broadly and particularly in Europe. So as we look forward, I think it's encouraging to see that the Chinese authorities are re-stimulating the economy. We're seeing the fruits of that in China itself. Not yet in Europe, but there's at least a bit of hope that we'll see some upside coming from Beijing. I suppose the other upside is that the central banks around the world, and particularly the Federal Reserve, have turned a lot more dovish recently. They're certainly suggesting they're going to be working to try and keep this recovery, keep this expansion going. So there's some stimulus in the pipeline. The big question we've got is whether the geopolitical risk, whether that's the trade hostility or Brexit and other European political issues, provide too much of a headwind, and that still dampens growth.
And the US seems to be at the epicenter of these trade wars now, or the rhetoric around it. Now, what do you think about the US in that regard?
Well, with regards to the trade agenda, there's been some encouraging noises about the negotiations with China. We're yet to see a deal and how comprehensive that deal will be. So until we actually see that signed, I think we should remain a little nervous. There are also some questions about the US-EU trade relationship and whether the US changes its focus towards its trade relationship with the EU, particularly autos. So that's an area of concern. But with regards to the US economy itself, generally it looks in good health. There aren't too obvious signs of excess or problems, particularly in the household sectors, looking very strong indeed, very low unemployment, pretty good savings rate, looks quite healthy. Although the economy will slow this year because the sugar rush of the fiscal stimulus is going to fade. But our best guess is that it's slowing and not stalling.
And close to home in the UK, UK markets have lagged hugely the last few years. Where does that leave the UK with Brexit and next steps for markets in terms of where they can go from here?
Well, the Brexit impasse is going to be very, very difficult to resolve. Ultimately, it comes down to how either the Conservative Party or the Labour Party can put forward a Brexit agenda that they each agree on, or whether there needs to be a general election in order to move to an outcome. I think neither are likely imminently, which probably means this ongoing extension of timelines, pushing the can further down the road, is likely to continue. The problem for the UK is whilst that uncertainty lingers, it does start to do, I think, more damage to the economy. We're seeing businesses not invest. They're employing, but they're not investing. And therefore, I think it's going to sort of keep a lid on growth. And also because of that political risk, I think international aversion to UK assets is going to stay, even though at face value, UK assets look extremely cheap.
Okay, Karen, thank you for your time. From the Morningstar Investment Conference, thank you for watching.